For the avoidance of doubt, the Simple Side does not provide investment, tax, or legal advice. As with any asset, the value of any asset class can go up or down, and there can be substantial risk that you lose your money buying, selling, holding, or investing in any asset. You should carefully consider whether trading or holding assets is suitable for you in light of your financial condition.
All right, as you just saw in that header, our macro regime tracker says to go long gold, and that macro portfolio is now up 5.69% year to date. We'll talk about that and so much more. Let's get into it.
Welcome to the simple side. Market beating picks inside. There's no jargon and no time to waste. Join the simple side and end up in first place.
All right, as always, welcome back to the Saturday send out from the simple side. We are going to talk about everything macro regime driven this past week in markets, all of our portfolios, trades, etc., etc., etc. But before we do that, I'm going to give you my reminders like always. You can go and copy trade us on autopilot. You can go and view our portfolios at thesimpleside.news /portfolios. You can go and view our macro indicators at thesimpleside.news /macro-indicators. And you can go find all of our research reports at thesimpleside.news /research. And you can hear even I'm stumbling on saying all that stuff. So what you should do is go to our newsletter, which should be linked in whatever podcast player you're listening to, or if this is your first time listening and you're on YouTube or wherever, go to thesimpleside.substack.com, or just go into Google and search The Simple Side, and you should be able to find either thesimpleside.news or thesimpleside.substack.com. Go to one of those two places and it'll be able to kind of direct you to the right spot. With all that being said, I just want to jump into our macro analysis. So I've been kind of missing in action for the past few weeks. Last week, I was on a retreat, so there was no Saturday send out, which means no weekly stock picks or any of that for paying subscribers. But we're back this week, and as an apology, I'm going to be giving away all of our current macro regimes to free subscribers for free. And of course, if you're a paying subscriber, you've got access to all this, which is updated daily on the website. So let's jump into it. The current macro environment is a hold from our model's perspective. So I've got a picture in the newsletter here that shows you the kind of speedometer of the market, if you will. And we're sitting at a 0.07, which is almost directly in the middle. -1 being a strong sell, +1 being a strong buy. So we're sitting right in the very middle. As a note, this perspective that I have comes from a macro statistical model that I'm running that has 12 different metrics that are all macro focused, like the Buffett Indicator and the spread between the 2 and 10-year yields, inflation data and other things. And so that's where that's being driven from. But what does hold really mean, and what really drives that regime or that sentiment in the market? And right now, what that's being driven by is a rough bond market, a rough bond market, and an overvalued stock market. And those two things are competing against a very strong gold market. The battle is kind of resulting in a stalemate for my models right now, which is putting us at that hold setting. But in general, equities are a sell, bonds are a sell, and commodities are a buy. Now, like I said, that website that I have, thesimpleside.news, is updated every single day with our most recent macro model. And what it does on the website is it spits out for you the current weekly allocations that we have between the SPY, GLD, and TLT. And if you don't know, those are 3 different tickers. SPY represents the S&P 500, GLD represents gold, and TLT represents bonds. So we have a portfolio and we split between those 3 tickers, where we should be investing based on the current macro environment. And so this past week, the allocations were 2% in the S&P 500, 97% in gold, and 1% in bonds. And like I said before, the current regimes across all those are sell for SPY and TLT and strong buy for gold. And that has basically been the case for the entire, I say the entire year, really just the past 17 days. That's been the main regime. And I think that kind of speaks volumes to what is driving the market. Is it positive underlying data that's bringing the S&P 500 higher? Or is it emotional investors that are investing and that's what's driving the market higher? And what I'm seeing and what our models are showing is that's what's driving the market. So the S&P 500 is up about 0.76 or 0.86% year to date. But in general, the data behind that is saying, no, run away from the S&P 500, run away from equities, move into gold. And so it should come as no surprise that that's what our model has been saying. But the SPY has been in a sell regime basically since the beginning of the year. We were in a slight buy and hold regime from 1.1 to 1.5, but since then it's basically been a sell regime for the SPY since then. Same thing for bonds. Bonds, I'm showing you a 3-month look if you're looking at the newsletter. It's basically been in hold, sell, or strong sell territory since October 19th. And since then, there's been a large decrease in the value of TLT. And of course, we've captured that loss, marking it as a sell for the past 3 months. And of course, year to date, marking it as a sell as well. But the one thing that our model has been loving is gold. And I've got a chart in the newsletter that shows you the rankings of our indicator over the past 3 months. In October, when we started tracking this, you see we've got a hold that kind of started at the beginning, and then immediately in late October, October 23rd, it transfers into a strong buy. And we've basically seen that strong buy from then up until the 15th, which was just Friday. And that has worked out great for us because it means in our weekly allocations, we're very heavy into gold. We've been over 80% gold index in our macro portfolio since the beginning of the year. And that macro portfolio has been performing very, very well. If you're a paying subscriber, every Friday is when we rebalance this macro portfolio. I'll start trying to be a little bit more on top of telling you guys what updates are happening within that portfolio. But in general, all we do is just invest based on those allocations on the website. We are currently up 5.69% year to date. You can see a screenshot of a SoFi portfolio that we've made that's been tracking this. We have a little bit of money in there that's been tracking it, and we're up 5.69%. So the macro regime is working, and as you're seeing, it's high commodities, low equities, low bonds, and that is because the market is very, very, very unstable right now. With all that being said, we're going to jump from our macro regimes into our weekly roundup. So if you're looking at the newsletter, again, if you're following along with me here, you'll see the 1-week total return of every sector compared to the SPY. So what you're going to see is that basic materials, energy, and utilities are the highest returners over the past week, which of course is showing you a shift into steadier cash-generating defensive sectors. Of course, if you go look at the laggards, healthcare, tech, and the SPY lagging third among those three. That should come as no surprise. Again, yields kind of jumped up on Friday. Mortgage rates are the lowest that they've been in a long time at 6.06%. But in general, market does not like anything that's kind of growth oriented. It's shifting defensive. And again, our models on the macro side are showing and agreeing with all of that kind of shift. So we're happy to see that those two are in line, but sad to see that people are kind of shifting out of those risk on assets. This past week, there were some interesting events that happened. We saw Verizon have that nationwide outage, and they're going to be giving $20 credits to everybody that was affected. Of course, that's going to be negative for Verizon in the short term, but in general, long term, not a massive effect on their stock or their portfolio. One thing that will be a massive change to companies is the proposed 10-year % cap on credit card APRs. This, of course, is going to be a huge negative for major credit card issuers, Visa, MasterCard, Amex, and it's going to be very negative for large banks. It's going to cut interest income down, and it's going to tighten credit availability, which means less spending in general. So it could have a large effect kind of across the total market. Banks are going to be willing to give out less credit because they can't charge as much for it. And that, again, will kind of decrease the total amount of money that's being spent in an economy. So yes, your APRs are going to get capped, but your spending limits are going to start getting decreased as well. There's a give and take in everything in the market. We have Visa in our flagship fund. We just added it for 2026. And of course, this information comes out and it's terrible for Visa. And I think it's down 6% since we've added it to our portfolio. So we're starting to see the negative effects of that potential bill already hitting the financial sector. There's a few more outlier events. I'm going to jump over those because we've kind of been getting into detail on a lot of other stuff. In the world of insider transactions, we've seen a lot of sells. There's been a few buys, but they haven't been nearly as big as the sells that we've been seeing. But the buying has kind of been clustered around insurance and biotech. And the selling over the past week was centered on space names and then consumer and finance. So no surprise, finance names are getting sells or sale ratings as the government says, oh, we're going to cap rates at 10%. So that should come as no surprise. In the world of analyst upgrades, downgrades, a lot of upgrades have been hitting the semiconductors and large platform companies, Applied Materials, Broadcom, Microsoft, Oracle, Netflix, all reflecting confidence in that AI-related spending. Intel was lifted from, I think, a sale to a neutral. And on the defensive and consumer side, Pepsi, Walmart kind of picked up a little bit of support. Roche and L'Oreal were kind of marked that neutral hold area, again, showing that shift to defensives. But the clearest message is that analysts are favoring chip equipment, chip suppliers, and high quality mega cap companies. So again, no surprise there. They like the AI race and they like defensives. So anyway, nothing to be blown away by. Now we get to jump into our stock research reports. Now, I've been kind of missing in action when it comes to the stock research reports as well. At the beginning of the year, I was kind of finalizing the new website and building the flagship fund portfolio. And so I've been focused on those and less on writing stock research reports. But in general, our stock research reports have been doing so incredibly well. And these stock research reports were requested by a paying subscriber, and that's why they came about. And so these are all available to be seen on our website, thesimpleside.news/research. So go and check those out. We've sent out a total of 14 picks, and of those 14 picks, 9 are closed. So we've sent out something and said, these picks have been closed or they hit their target returns. Of those 9, only 2 have been losers, and the other 7 have been winners. Of those 7, their average return has been 26.5%, so a very impressive return on those winners. And our win rate is 78%. Our best pick has been Figma at plus 142% returns, and that was an IPO. Speaking of IPOs, we are going to be sending out some information about some upcoming IPOs that we think will make great investments or IPO flips if you're into that sort of thing. Retail investors like us have been getting screwed by big institutions on the IPO side of things for so long, and I not that I want to be a proponent of IPO flipping, but I think it's time to screw them back a little bit. So I am a proponent of doing that, but in general, just to get a overarching feel of the stock research, it's been doing very well. We currently have 5 open positions. Out of those 5 open positions, only 1 is negative, and that is ticker NICE. And they've been getting affected by all of the bad news coming out of Israel right now. So, you can kind of see why all that has been happening. I will be posting more and new picks this week, so just be on the lookout for all those coming out. Those will probably be available for paying subscribers only, because the returns on some of these upcoming picks could be very substantial, like that Figma 142% with these new IPOs. And I have one very risk-reward pick, and I don't want to send those out for free because they are very high potential returns, and I have to reserve that for those people that are paying me money. So if you're a free subscriber and you want to get access to that, you just need to join paid. And if you're following along in the newsletter, there's a link to go and join our paid. You can do it at thesimpleside.substack.com patreon.com/subscribe, and you can join our paid there. Now, if you're a paid subscriber, you'll notice that there's a paywall in our newsletter. And if you want to continue reading, you'll get access to our flagship fund, all of our holdings and returns, our AI secondhand effects, all of our holdings and returns, and our tech-focused growth portfolio, again, all of our picks and returns for that as well. Now, if you're a free subscriber listening to the podcast, let me just tell you what these returns have been. Our flagship fund has been lagging since we posted it on autopilot. In general, we've experienced a 39% CAGR on our flagship fund, so very, very impressive. But since we posted on autopilot, we've lagged 2.88% returns. The AI secondhand effects portfolio has returned 32% since July of 2025. And then we've got the tech-focused growth portfolio, which is up 15.87% since July. So vast outperformance from the tech-focused growth, the AI secondhand effects, and the flagship fund is the only one that's lagging. But in general, big outperformance there. That is all I've got for you. We've got some changes coming to the flagship fund. We've got some changes coming to the tech-focused growth portfolio, and we've got some changes coming to the AI secondhand effects portfolio. All of that is incoming, so be on the lookout for it. And in general, we're doing very, very well right now in a market that is relatively struggling, I would say. We're outperforming what seems to be on all fronts. So well done to everybody that's been following and joining me on this journey. Again, there's a lot of different places that you can go and find me and find my data. The best place to go is thesimpleside.news. And from there, you can kind of find your way around and direct yourself to, thesimpleside.substack.com. And from there, you can kind of find your way around and direct yourself to our data website and all that other stuff. So thank you so much for your time and attention this weekend. We will be coming at you with some research stock picks and some IPO picks this week. And I look forward to seeing you guys all next week. Have a good one.